Then on this day, we have got a very important session that being taken by Mr. Dr. Kishore Nuthulapathi. He is a very versatile professional with high degree of knowledge, and he holds several degrees, and he has got rich experience in finance. I have got the opportunity of introducing him. Dr. Kishore is a corporate finance professional and an economist with 25 years of experience. He is a rank holder in the PhD Finance, MBA, MCOM, and LLM, and is a qualified company secretary. He is an expert in corporate finance, project finance, PPP projects, venture capital, credit, legal, accounting, and HR. All these qualifications speak highly about him, and he has got a very rich experience. Just read out his further achievements. His employments and associations include Ocean Sparkle, Nagaraj Bank, ICICI, SRE, ILNFS, Beckham, Mahalakshmi, PRECA, and Meenakshi Groups. Presently, he is serving as a director of Lodestar Strategic Private Limited and Beckham Projects Private Limited. Previously, he has served as director and a committee member of several organizations. He received the Best CFO Award from several organizations, including Economic Activity Now Awards. He has professional associations with and addresses several with forums like CI, FTCCI, PRMIA, USA, ICA, NHRA. He is a member of the board of the management of Pochampalli Bank, one of the leading UCBs. He is a part of the Africa-Asia Forum on Corruption, an international organization headquartered in Indonesia with the regional headquarters in 10 Asian and African countries. His professional positions include a board member at Great Tower, board of studies at Oxford International University, board advisor for startups, financial mentor at the Startup Grid, the world's largest startup community platform under the use of Google and AWS, board of studies member at SSIM, AICTE approved Autonomous Business School, etc. He is editorial member of the banking research journals. Dr. Kishore delivered expert talks and case studies in various locations in India, Singapore, Dubai, Abu Dhabi, Malaysia, Thailand, and South Korea in person, and online sessions in Japan, Indonesia, China, etc. He delivered sessions for civil servants like IAS, IPS, IFS, ISS, IES, etc. Commissioners, government officials, regulators, bankers, chartered accountants, public services, cost and management accountants, advocates, investment bankers, stock brokers, management professionals, startup funders, faculty members, and at ISB, the prestigious business school at Hyderabad, and various IAMs, Watson, NIET, FIEO, NICMAT, GITM, REVA, KLU, etc. He authored articles in leading platforms, guided about 1,000 research projects, and participated in many conferences. He has been championing for financial literacy on pro bono in collaboration with the FLAI and has been mentoring startups, MSMEs, scholars, and aspiring professionals. Dr. Kishore is an international based out of Hyderabad. He traveled widely in India and abroad. His hobbies include reading, research, mentoring, and traveling. We are very fortunate to have such a luminous professional and intellectual. Let us hear to him on the topic of national monetization pipeline, valuation of assets. I welcome you all again for this Saturday webinar, which I conduct regularly on second and fourth Saturdays at 7:30 a.m. to 9:30 a.m. And if there are any new members who have joined recently or for the first time, I welcome you all. And now let us listen to Dr. Kishore Nuthulapathi. Dr. Kishore, thank you for accepting our offer and request to address this forum, which consists of registered valuers who are members of, who are professionals in us, mostly in securities or financial assets. Some are from land and buildings and plant and machinery. Request Mr. Dr. Kishore to take over the session.
Sir, first of all, my sincere thanks to Sivaprasad sir, and my sincere welcome and thanks to all the members of our association. I can understand how professionally the meetings are conducted, the sessions are conducted. When Sivaprasad sir spoke to me 3 months back, reserving this date, trust me, dear professional friends, even with IAM and ISB, I could not see this kind of long date and fixing the date. And I forgot the date, in fact, to tell you, because when sir told me 3 months back, I thought, so he's just lining up many speakers and it may or may not happen. It is just a caution or a courtesy invite. Again, he reminded, stating very clearly, this is the date we agreed upon. So you are joining and you are addressing. So I am very pleased to note this kind of professional approach. And in fact, professionals and professional approach need to go together. My sincere thanks to Sivaprasad sir and to all the members also, because I can imagine what kind of personal initiative and effort we are all taking to participate on a Saturday early morning. And so with that speaking intro, with my humble thanks to all of you, I open my presentation. Fine. Yeah. I trust the slide is visible.
Yes, sir.
Yes, ma'am. Thank you, ma'am. Thank you, ma'am. And my thanks to Vijayalakshmi madam also for rendering excellent coordinating service and timely reminding. Early morning one reminder, I thought definitely it was ma'am, and I did not get disappointed. It was she. Thanks, ma'am.
Yes,
Fine. Small disclaimer, sir. I'm part of Economic Times and couple of sir, in fact, spoke about them. So it is just that. Fine. So we speak about economy, we speak about capital, we speak about valuation, we speak about assets. The chain starts from savings of government, savings of private sector, savings of households. These three saving blocks together form capital for any economy. And that capital translates into
हाफ पैंट पहना है ओके हाफ पैंट नहीं अलाउड फुल पैंट वाले जा सकते हैं
into
फुल पैंट
investments.
वाले जा सकते हैं
And those investments create employment, and the employment creates activity, and the investments and employment together create assets. And the assets, it is the assets which in turn create employment, create savings, create capital, and the chain goes on. And that chain, when it is active and when the cycle is growing in its magnitude, the gross domestic product, the GDP, the economy grows. So in this chain, we have observed that assets are the key, be them land and buildings, financial securities, or the other assets. So financial and non-financial assets, all three: land, buildings, and our financial securities, and of course plant and machinery, which we include in land and buildings, plant and machinery sequence. A quick look tells us that savings as a percent of GDP has been high until 2008. Thereafter, they took a slide, and how steep is the slide could be seen here with the orange or red color curve, which shows that after 2008, there has been ups and downs intermediately, but the savings as a percent of GDP has been on a slide. Same is the case with everyone, the households, private, government, all of them, public, all of them. Now, as a savings, the same curve imported here, as a savings took a slide, the investments also took a slide, which is corollary and natural. The gross capital formation is from the savings and the investments took the slide. This green is nothing but there is a change in the series of the measurement, but otherwise broadly it is the same for us. Now, the gross fixed capital formation, which is one of the most frequently measured variant. It is called high frequency indicator. This HFI, high frequency indicator, explains us, is the GDP growth productive or not? The value of all the goods and services rendered and consumed could be GDP, but then is GDP healthy in its sense of having more investments? Because only when there are more investments and assets created, supported by the gross capital formation, which specifically speaks about investments only, will the GDP remain sustainable. Then money doled out, be it helicopter money or the easing out of monetary policy and distributing money, or letting the money flow, making money more liquid and allowing people to consume more, then also GDP would grow because more and more goods and services would be consumed. But the later GDP, what we spoke about, wouldn't be sustainable because the subsequent years will not see similar activity or similar cycle in the absence of the much required investments, providing employment, creating purchasing power, and then causing demand for the goods and services. Then the demand in turn resulting into the cycle of expansion of the businesses, which warrants further investments into assets and which facilitates the growth of GDP thereafter. Having seen the savings, the investments, and the gross capital formation patterns during the past 30-40 years, let's quickly look at why these assets are required, why these infra investments are required. Of course, all assets are not infra assets. There could be some other assets as well, but of late we are speaking more about infrastructure assets because they are of high value, magnitude wise, value wise, and even the multiplier factor wise, they're quite sizable because it is the construction and the real estate sector which can cause demand for about 1,200 items, sectors, subsectors, which can create about 250 billions of capital assets every year to the economy. And therefore, it has come as a very important segment for the whole of the economic development. As we all know, GDP's formula, GDP has got three kinds of computation. The most popular which we adopt is the expenditure format, which is the government expenditure, which is the public, the government spending, then the private spending, which is called public spending, then the investments which are made into the economy. The investments are none but gross fixed capital formation. As we spoke, GFCF is one of the most significant high frequency indicators. Gross fixed capital formation. It is creating the assets. It is adding the assets. It doesn't include financial assets. It includes only the real assets which are getting added on a net basis. Now, the sum of these three plus exports what we make minus imports is the GDP formula to compute the GDP volume on expenditure model format. Now, if gross capital formation increases, the economy will prosper because assets are created, employment gets created. If the gross capital formation, gross fixed capital formation is low or getting lowered, the economy will suffer in terms of lack of sufficient capital and therefore it will have to borrow more. And this is the most important thing. Borrowing is not all that wrong, need not be seen as unproductive, but when the gross fixed capital formation is low, borrowing is odd. It is unproductive, because if borrowings are higher, for them to be productive, the gross fixed capital formation also has to be higher, because GFCF, the gross fixed capital formation, is nothing but additional investments. So more borrowings, more investments is fine. More borrowings, less investments, or same level of investment is dangerous. This is what IMF has spoken. The private arm of IBRD, the World Bank, spoke 4 days back in its consultation paper, stating that the governance broadly in India is fine. The measures and the reforms what India is adopting are excellent, par excellent. But there are 2 counts on which it made, secondly, if not adverse, cautious observations. Number 1, it finds that Reserve Bank of India, the central banker, has been intervening in the forex market too often than required. Number 2, the government borrowing, the government general borrowing and the overall total borrowing, government borrowing has central government borrowing and states borrowings. All these put together is called total government borrowing to GDP. The total government borrowing to GDP is higher at 82% versus the normative number to be seen for India at about 50 to 55, and the Indian own measure of comfort level standing at 63%. So assuming our own measure can be taken as a benchmark, 63 versus 82. So there is a 20% increase in the borrowings of the country. It's a cumulative borrowing of the state governments and the central government. This is stated as a risk factor for the economy in the consultation paper by IMF. And you've seen what has happened on the day. This one statement, 85% of positive observations, 2 negative observations, caused stock market to fall by almost, some of the sectors have lost almost 5 to 8%. Media has lost in a day volatility of 8%, and single day loss was for 5.2%. Realty, IT, pharma, many sectors have lost almost the highest loss in the past 12 months on a single day. And then came a bit of recovery after the observations are properly understood.
May I interrupt you, Mr. Kishore? Are you showing the slides? Now
Yes,
we
sir.
are seeing the slide, the backdrop requiring infra investments.
Sir, is this backdrop requiring?
Yeah.
Same thing, sir. I'm speaking on the same thing.
Okay, thank
Yes,
you.
sir. Yes, sir.
And occasionally you please report the chart box, because there were some queries from the members.
Fine, sir. Fine, sir. Fine, sir.
Thank
I
you.
have not kept this.
Either you may watch them occasionally or at the end.
Okay, sir. Okay, sir. Okay, fine, sir. Fine, sir. Okay, so some few questions. In fact, isn't high savings also detrimental to GDP growth? Good question, sir. Good question. Indian economy is broadly capital requiring economy. Therefore, high savings are good for Indian economy. High consumption is good for the Western economies, which depend mostly on consumption only. Our growth, until we turn a developed economy, would still be dependent on high level of savings, because it can reduce the borrowings, it can reduce the cost of borrowing, it can facilitate the capital formation and asset creation and employment creation, and in turn creating GDP growth. So there is partly positive, partly negative answer for this. Then right, sir. Then
high savings, does it lead to lower cost of borrowing, sir?
Yes, sir. As the savings increase, the supply of the money, we have got MO, which call MO, M0, which is a base money. Base money is nothing but the money which banks park with RBI and the money in circulation in the economy, that is MO, and we have M1, which is nothing but the base money plus you add the demand deposit, which are broadly savings deposits and the other post office deposits which can be drawn on demand. Then we have M2, which is nothing but the M1 plus the demand time deposits added. Then M3, which is M2 plus the mutual money market investments, liquid investments, etc., getting added. Now it is the M3 which is the broad money which will facilitate us to understand what's the liquidity portion in the economy. Presently, there is about 2.3 lakh crores today, as on today, yesterday, 2.3 lakh crores of liquidity crunch in the market, going by the option number of RBI. The practical number could be slightly higher, maybe about 30-40% higher, which we have seen as per the experience. So the capital shortage causes the call money rates and OIS, overnight index swaps costs going up, and this will cause the borrowing costs higher. And when the borrowing costs are higher, the corporate sector or even the household sector will not invest more. They defer their investment plans or purchasing plans. Therefore, higher the savings, higher capital formation, and lower the supply and demand.
Another way to look at it, sir, this is a particular definitive way. The other way to look at it, higher the interest rates, higher the savings. Higher the interest rates, lending rates are higher. Lending rates are higher, then the cost of borrowing is higher. So it depends on where is the starting point that you're looking at it. So the principle is that, therefore, they say that the consumption and savings, there's an optimal ratio of between 30-32% globally, actually. Now, whether it should be much higher for a country like India, which is a developing country, it is because you may not want to over leverage. Just like a debt company, we don't want to over leverage. So we don't know what is the cutoff point that we are looking at it, which will ensure that we are in a control situation due to any eventualities of sudden surprise. I think that's where I was coming from, probably because you do heavy on savings, you struggle on the other side, and eventually you will end up not having new investments happening, and if new investments are not happening, unemployment will not happen, and we'll be in a vicious cycle. That's the reason why I asked this question. I think there is a tip of point beyond which you should not have savings as well.
Yes,
and that's
sir.
exactly why RBI through monetary policy keeps working on this interest rates.
Good analysis, sir. Very good, sir. As you rightly said, there is no fixed format for all the economies, and also for the same economy, always it varies from time to time, and there has to be a trade-off. Too much savings, not spending, also will be a doom, and all spending and no saving also will cause harm. So there has to be a trade-off depending upon the economy, the situation, and the availability of the M2 and M3, etc. Right, sir. So fine. So now in this, what we have noticed is, at the moment, because of the lower gross fixed capital formation, India is still having capital shortage. That is the reason why we are borrowing heavily, and that's reflected in the higher government to GDP percent of 82%, borrowing of 82%, and this was the observation which IMF made. Keeping that aside, even for us, we are in need of capital, and the capital, if is required for creating investments, that requires more capital, and it triggers the further economic growth. Okay. Sir, did the slide move, sir? Now I got to NIP slide.
Yeah, we can see that.
Okay, fine, sir. So this is the national infrastructure pipeline, which is made for the government of India. And they said this last but one column total sum of 111 lakh crores is the most important number what we could see. So the sum of the National Infrastructure Pipeline announced by the Finance Minister and the Prime Minister together, stating that government commits to see it's partly by government and partly by sectoral organizations like public sector institutions, etc., cooperatives, and also by private, that 111 lakh crores will be the investments which are required. These are not the ambitious numbers. These are found and stated by the government as required, and therefore the sub plans and plans of all these amounts in terms of project planning was made, and the project titles were also announced for most of the amounts. Of these 111 lakh crores, what was stated, we are looking at about the core infra, which speaks about energy, renewable energy, atomic energy, and gas sector, roads, railways, which sums up to 60 lakhs 91,000 crores, close to 61 lakh crores. So this is nothing but coming from these numbers up to this. Now, of these 61 lakh crores, the central government budget, which they identified as contribution possible from the central government, and therefore they commit the number, is 14 lakh crores, 14 lakh crores, which is 23%. Now, the borrowings, be it from the public sector debt, be it from the borrowings, internal borrowings beyond the budgetary allocations, be it external aid, be it other small borrowings, and be it PPP, which comes again in the form of equity and debt from the private, all of them put together is almost close to 40 lakh crores. This 40 lakh crores, which is 40 trillion, has to come from the private or the debt components, private sector or debt components. And this can happen only with the support of monetization of some of the assets by the government. Only then the capital gets triggered. By the way, the 40 trillion what I spoke is not into buying the assets. That has to come to create new assets. It is 14 lakh crores which central government will provide. Of these 14 trillion rupees what we spoke, central government thinks it can mobilize, and it intends to mobilize 6 lakh crores by monetizing the already existing assets, thus reducing the net burden on the central government to about 8 lakh crores. So now you can imagine, of the whole of the program of National Infrastructure Pipeline having 111 trillion rupees, around half, 60 trillion is of core infra, of which 14 trillion is from the central government direct budget. Of 14 trillion, the identified source, one major source is monetization of existing assets owned by the central government only. The monetization of central government assets only are estimated to fetch and contribute about 6 trillion, and the balance 8 trillion from the budgetary support. So now you can imagine what is the volume government would have thought as contributing to the whole of the program of 111 lakh crores. In the program, when government thought, okay, we will monetize the existing assets, certain challenges are imminent. Those challenges are listed out. Those challenges and challenges which are already existing for many of the assets of the central government are listed here. First, how to give life to dead assets. There are many dead assets with the government which we may not acknowledge, but we know. There are many sleeping assets, rarely used, once in a year, few times in a year, but certainly not completely used or properly used. How to reactivate such sleeping assets. There are assets which are utilized regularly, not sleeping though, but they are utilized at a lower capacity than what they actually hold. There are assets or the projects which are being utilized to the full or optimum level, but they are not having the sufficient viability or the profitability in their operations. There are projects which are well used, many assets and projects, but they lack, rather they are yet to get the required timely or trendy features and capacities. And to enhance these features, capacities, or to add to the additional capacities, or to create more assets, modern assets, as we spoke a while before, debt gets added. So how to avoid further debt for creating the new assets, the new required assets? Then how to generate, then you want to avoid debt, then how do you generate funds for the new info projects or any assets in fact? And how to enhance the participation of the private sector in the public projects. These are the challenges what government face. And in a bid to address these phases, after high level deliberations among the government and in consultation with professional bodies and some policy contributors like you and me, they've come out with this national monetization pipeline. So it's basically planned, but it is a pipeline because it wouldn't happen at once. It wouldn't happen in a year. It happens over a period of time. It is at that juncture, the government thought we should understand how the asset monetizations are happening elsewhere. Do they happen? If they do, how are they happening? And if they're happening in a way, what is relevant for those economies? Can we adopt the same models, or do we need to modify them to suit to our requirement? For the other questions, what they fed. The predominant models what they studied are Australian and European. London is traditionally one of the largest economies which had a lot of asset monetizations. Australia is a recent example which met with a lot of success in monetizing many of its assets, which include the port sector assets, the jails. So jails are privatized there. You can imagine what kind of privatization level they have. All of them, or maybe majority of them, are privatized. And even it may come as a surprise to us, the land records registry, which is the most bureaucratic functioning department in the government of India or in all the state governments, it's a state subject, is privatized in Australia. So if you want to sell, buy your land building, there is no government body which is making the registry, all those things. It's a private body which is making the registry. Now you can imagine what kind of privatization or what kind of monetization Australia would have achieved, holding the much required or sufficiently required control, regulatory control on the privatized assets, projects, and the entities as well. Couple of them, which I found thanks to ChatGPT, which helped me quickly to see what are the valuation methods. Unfortunately, I could not see any asset being sold as an asset. ChatGPT had its own limitations, but then it gave some examples which showed us that there are good amount of asset monetizations and the valuations were made on certain methodologies, approaches rather. So one, asset-based, market-based, then income-based, which is again your income-based, then book value approach, and of course DCF. These are the methods what are adopted across the world in other economies, LATAM, South America, then the Northam, the Americas and the European economies, and of course the Australia and New Zealand also. No. If you monetize, what are the benefits to the government? Optimal risk sharing can be achieved. What is the risk? creating the demand for a facility what is lying low is a challenge which government is not able to meet with. The examples are the port sector assets. The seaports, except JNPT and Visakhapatnam Port Trust, all other port trusts are not able to achieve their optimum capacity utilization. They are far lower than what they could achieve. And all private ports are performing, be it Mundra, be it Gangavaram, be it Krishnapatnam, be it Dhamra, be it Paradip. All of them are, of course, Paradip is owned by government. All of them have been achieving at greater than average levels of capacity utilization and are seeing higher profits. So what is lacking in the government sector? Our government entities, let's say JNPT or let's say MPT, aren't competent, aren't efficient. They are. CPT aren't efficient. They are. But then the ability to generate demand, the ability to reach out, the ability to flexibly price the fee, all of them are absent with the government because of the rigidity which is inbuilt in the government sector. Therefore, risk sharing can be achieved. So the risk of generating demand is left to them, to the private. The private sector efficiencies can be derived. It could be in terms of capacity utilization, fee fixation. Government entity can't fix a fee as per the cost. It has to be as per the welfare requirement. Private wouldn't look at welfare. They fix the price as required to remain viable. And people will not quit because they understand they're again the private sector. The households are private. Understand that why will they give at a lower cost because it's a private entity and we have no commitment to the private body, the price what it is justified at, and we avail of the service or the good J&S. The locking of funds for a long time can be avoided. Assuming the project is viable like JNPT or Paradip, and then government can also get funds, but the funds stand or get locked in for a longer time, that can be avoided. And the upfront funds can be received by monetizing the assets. And they can cater to the public service needs, the people needs, private involvement. And they can achieve several greenfield projects by adopting suitable models, including PPP, etc. The ownership can be retained by this asset monetization model. The ownership can be retained and only limited rights need to be transferred without transferring the very ownership of the asset. The regulatory power to exercise, be it fixing the fee, ensuring public interest, be it modifying, be it giving subsidy if required, all of them are still with the government. Look at the gas, oil and power sectors. Government can still give subsidy of even after monetary assets, even after private operates them. Government can still offer subsidy through the functional formal mechanism and let the private body operate in its private sense. But whatever subsidy government wants to give to its subjects can still be given even after asset monetization. And if it turns successful, it can emulate successful further operational models in other projects as well. So the role of the government can define and perform well as a regulator, monitor, supervisor, and the role of the private can be an asset operating entity or entities, and all the stakeholders, government, the private, and the users, everyone or all the stakeholders can derive benefits. Now, what are the benefits for the investors? So you would advise your clients to participate in asset monetization. You, as a valuer, will advise your clients to look at normative value, and you will caution them not to go beyond X value because you, as a professional, would value the assets put for monetization, and you will guide your clients to go by this guideline value which you have given. What are the benefits to the investors? the yield compression is achieved. What does yield compression mean? Any asset or project will have three phases. One, development phase. Two, construction phase. Three, ownership cum operating phase. It's a development phase which is fraught with a lot of risk. Once development is crossed, what is the development? Purchasing the land, preparing the DPR, getting the valuation done, the high level valuation done by a professional like you, factoring in that, arriving at the profitability, then applying for the approvals, getting the approvals for the project, for the land, and finding or identifying and finalizing the team, the consultants, then the offtake contract, supply contract, O&M contract, equipment contract, EPC contract. So finalizing all of these things is in the development phase. That is the most riskiest part in any project. Now, the assets which are put to monetization have long passed the stage of development. They pass the stage of construction, which has lower risk than development phase, but still has significant risk. And now they are in ownership cum operation phase, which means you are able to track, note, and assess the actual receivables the project is enjoying. So you can build on your valuation on these stabilized, proven cash flows. When a project gets into ownership and operation mode, as a finance professional, as a valuation professional, we will alarm our clients if our clients aren't cautious on that to refinance their cost of their borrowings. So this is a natural phenomenon. Once an asset attains the yield compression fees, banks stand in queue. They will offer you for a lower debt, replacing the higher debt. Even after you consider the prepayment penalty, if any, and the cost of absorption of the processing fee, the cost of absorbing a consultant like you and me, advising, valuing, all of them, it could still be much profitable to replace low-cost funding, which the groups like Reliance, Adani, Godrej, and Birla have done and proven, including Tata also have done and proven to the world during the past 80-90 years that yield compression is a business model, is a finance model. And banks used to see this as a shady transaction or as an unwanted transaction. But today, it's so matured that if your project is successful, be it a building, be it a port sector asset, be it any other asset, banks themselves come and offer you that we studied your project, we understood that you are sitting on a higher cost debt, we are willing to refinance your debt at these things. Refinancing when you could not repay the debt is bad in the banking. Refinancing when the asset is properly serviced is good in the bank. Being an ex-banker, I was part of a couple of refinancings, and then we had the privilege of listening to our seniors explaining why they should make a pitch to so and so private party offering the refinancing debt. In some cases where our bank itself has lent, we took a voluntary step of offering them refinancing. Then when we had the inquiry to our seniors, our directors told very clearly, you don't refinance, someone else will come and tap their door, and then you lose a very good client. And all the effort what we took in curating the period of development and construction is all gone because the asset is now with some other lender. Would you like to see that, or would you like to respond to the market and be the first to offer them the right deal and hold the account, loan account? So that is the level of maturity and understanding that the banks today. That is yield compression. Then the flexibility and ease of mobilizing debt funds. Of course, when you acquire an asset in monetization, you are allowed to mobilize debt. And can it be can the asset or the ownership be transferred? Should you prefer to exit from the investment? Of course, yes. That is allowed in the recent past, last 2-3 decades. Earlier, once an asset is allotted to you, sold to you on a concession or at a subsidy, it is supposed to be with you forever. Transferability was always a big question. And when you partner with the public sector, you have fantastic brand image. And any examples? Yes, of course. Tata partnered with Government of India and Government of Tamil Nadu, and the Titan watches, the Tanishq jewelry, and there are 11 sub brands. They have been giving Tata Group a lot of mileage, tremendous amount of profits, and the royalty what is being paid is as per the formula. The high side, the upside is all with the Tata, and it is seen as a government sector by the suppliers, vendors, etc. It is seen as a private entity by all the consumers, and it is seen as a Tata brand by the loyal patron customers, consumers, and clients. And it is seen as a safe partnership by all the banks to lend money. It is seen as a fantastic partnership by the investors to invest into this company. There are a few other examples though. This comes as a very handy example. So the brand image for them has come with this partnership, and none is able to bang on compete with these 4-6 brands or all the 11 brands, because it's a fantastic public-private partnership of Tata. And you can maximize the returns and build expertise in a sector where you enter through this asset monetization program. Within the formula though, then you hold rights on the assets without any clog. Why? Because you enjoy sovereign immunity. An asset which you buy from the government has a better title than an asset which you buy from private. General statement. It doesn't mean always. There are cases where, couple of cases in Hyderabad, one of the group launched 100 floors tower 23 years back, and the land what government has given was Waqf land, and it was fraught with a lot of legal issues, and that group almost became bankrupt because of that one deal. And you know which group I spoke about. And it shifted from its base from Hyderabad to Delhi and lobbied a lot, still could not do anything and got into problems. Today it is, all of its projects are in NCLT. I'm sure a couple of our professionals must be valuing or acting as a liquidation professionals also for those assets, mostly into power and infra. You can enjoy the sectoral participation into multiple sectors or in the sector. You can diversify by getting into a new sector. You can increase your exposure if you're already present in the sector. The case of airports, the case of seaports, the case of railways. Within railways, you're being a contractor doing some contracts. Now you can become a railway station operator as well, owner come operator as well, with a limited right to own and unlimited right to operate in the formula. And because the assets which are monetized are mostly brownfield, means they are proven. It just they need augmentation of some features, capacities, and a bit of upliftment and better and efficient way of operations, and therefore you get more returns. So the development risks are far lower. And even if it is greenfield, development risks are very less because it is from the government. Mostly the assets are brownfield. There could be few greenfield, let's say land of railways being monetized on a lease basis. It is still greenfield, but the development risks are far lower because it's a railway land and they give you the permissions and the approvals should come forth. And broadly, it is a relatively safer project than a pure private project. This is a simple model explaining what is the asset monetization happening. The public authority, be it the government or the department or the SPV or whichever is the belonging to government and owning the project, it transfers the asset with limited rights to the private sector, and the private sector is given concession to collect the user fee, toll, or any other charges, whatever be the charges from the users of the assets, and in turn for receiving the assets with the concession is rights. In fact, the private investor pays consideration to the government, could be upfront, could be deferred, could be partly upfront, could be partly deferred, could be on a revenue sharing basis, could be any other modalities aside, but the consideration is paid by the private investors, the suitors who are acquiring the monetized assets, which are targets. So the suitors who are acquiring the targets will pay the concession to the government. Now, post acquiring the monetized assets with the rights, the private investors aren't owners. In most of the cases, they aren't owners. They are concession holders, concessionaires. Being a concessionaire, they create, they augment, they operate, they maintain, and they collect revenues from their operations and will remunerate themselves and will share the amounts to the government as a part of consideration. This is what the NMP document speaks about as the good features of asset monetization, having collected the information from across the world. It says a good asset monetization program is structured around monetizing assets with high appetite among investors. So you should not sell what is not sought by the investors. Sell what is hot. Then it serves the purpose of the government in terms of price or value discovery. It serves the appetite of the investors and it benefits the users with proper regulation. Reinvest the proceeds, the asset monetization proceeds, into new assets or augmentation of assets or the services, the G&S, that citizens or the public require. Then a good program helps new asset creation without necessarily increasing further debt or higher, without having higher debt. Or the other way, the three options, what Miss Finance Minister spoke across the table in her inaugural talk to the invitees and the policy officers was, gentlemen and ladies, we have got three options. Number one, borrow if our FRBM permits. Number two, if FRBM doesn't permit, look at the reform scale and increase the taxes if possible. If these two aren't possible, I've got another plan, which is National Monetization Plan. This need not be done at once. We do it as a pipeline. And these are the numbers what we are speaking about, high level estimates. High level estimate is thumb rule estimate. The granular practical estimates to be drawn later. So in that, the first statement itself justified that higher debt detrimental, higher taxes not viable. The third option is asset monetization. And the good program targets efficiency gains. It's not just selling off. It has to improve the efficiency of the asset which is being sold. Recently, I've been to four airports, all four biggest airports. Bangalore, Mumbai, Hyderabad, Delhi. These are the best airports in India. I could sense, not naming, I could sense, even Ahmedabad also, in fact, of course. 1.5 months back, I visited Ahmedabad also, and then I spent a good amount of time moving around just to see the upgradation in the airport. I could see there is tremendous amount of efficient way of utilizing the asset. And the chance of someone lying on the floor, lying on the chairs, or leaving some baggage there and then moving around, or water leakages, all of them are properly addressed as if it is your house, what you will set it right as you purchase a new house. These assets are, which are already good assets. Kindly note, they are already good assets, best assets of the country. They are bettered. They are bettered. So with a bit of apprehension, when I walked around, I could not miss observing these upgradations. And I did spend a good amount of time in speaking to the manpower working there in various functions. And they had satisfaction about the upgradation of the infrastructure, control, etc. Although they had their own problems and stating we are having less resting time and our money salary has to be increased, all those things aside, in a man is a hopeful creature. One would hope more and will deserve more, of course. So this explains to us that efficiency gain happens when monetization happens, if the program is done in a rightful way. And it should enhance the investment opportunities and the depth and liquidity in the infrastructure as an asset class. Only then can we see more and more capital formation. Today, why did we allow InvITs, REITs, and SGBs, all of them? Why did we allow, as a country, we never thought of discounting money, means LRD, lease receipt rental discountings, then salary discountings. These were not as a part of our Indian culture, not part of Indian culture tradition, but they were allowed because the capital formation is seen as possible when you create new asset classes for the public to come and invest. The investor, when I say public, investors. So the objectives of NMP as stated are serve as a medium-term roadmap for the line ministries, 12 line ministries and agencies, provide medium-term visibility to the investors on infrastructure assets pipeline. Unless there is a visibility, you will not participate because you don't want to own a one-off asset, be in the sector. You want to be a long-term player, be it Reliance, be it Tata, be it Adani, be it Birla. As they enter their respective sectors, if you have seen Reliance Oil and Gas, Adani Ports, then Birla Cement, then Tata into the airlines, you could sense as we are speaking, you are more knowledgeable. Learned professionals can sense that all of them, while they have started with one, they were on a spree of adding the capacities, expanding projects, spreading around, not only in India, in some cases even out of India. And they've leveraged upon their expertises, what they've built, and they've proven within their initial projects. So that visibility is very important for an investor to bet big and commit more investment and add the best of the features for demonstration and also for viability. Provide a platform for the ministries to track the asset performance, which is absent now. Then bring in greater efficiency and transparency in the public assets management. These are the assets and variables. Maybe I would quickly speak about a few and then take you through. I have just copied it from the NMP document, this part, because these assets are identified after a thorough department level, ministry level, department level, and the officer level, the line officer level discussions, having understood what are the assets lying, how many of them have the potentiality for monetization, and how can we segregate those assets for monetization. As far as the roads is concerned, about 132,500 kilometers is identified. Power, close to 172,000 kilometers transmission lines and substations. And power generation, 60,000 megawatts. Most of it was thermal. And about 5,000, including solar and hydro, as a renewable energy, RE power plants. Then airports, about 137. We have seen few of them monetized thereafter. Ports, there are 12 major ports now. 13th one is getting added. And the handling capacity of ports, not the ownership of ports, only handling capacity of ports, 1,500 MMTPA. Telecom towers, about 70,000 towers. Optical fiber cable, and close to 5 lakh kilometers, including the Bharat net additions and then the replacements. Railway stations, close to 7,400 railway stations. railway tracks close to 1,25,000 track. Then natural gas pipelines, which are presently safest by any measure, close to 20,000 kilometers, and petroleum and product line means other than the liquid things, the products, etc., about 14,600 kilometers. Warehouses go by the metric tons, about 800 lakh metric tons, and stadium, about 5 national stadium and various regional sports centers. These are the assets which were identified for monetization. The framework what government announced is monetization of rights, but not the ownership. Assets shall be handed back to the government by the private at the end of the concession period or transaction life period. Mostly brownfield projects, de-risked assets, having stable revenue streams are being monetized so that the high return earning development phase, the higher return earning development phase, or I should say highest return earning development phase, higher return earning construction phase projects aren't allowed to be handled by the private or owned by the private. It is only the yield compressed assets, yield compression stage of the assets, which is the ownership and operation period, which generally have low returns, are only monetized, are only put for monetization. Structured partnerships under defined contractual frameworks with strict key performance KPIs and performance standards. This allows government to hold its regulatory control on the assets and the private. Let's say the user charges, let us say the addition of further amenities, let us say the expansion of the assets, all have to be as per the regulatory formula stipulated in the contractual documents which entitle the asset operational rights to the private sector. The approach, what I spoke a while before, was like this. The assets were identified, listed out, debated, and the asset values were found, and the stage of each of the assets was also assessed. And then they understood that this is the potential asset base. They created the potential asset base, and then they understood while these assets are brownfield, proven, revenues are there, but still require certain things, including augmentation of features, augmentation of amenities, capacity additions, replacement of assets, modernization of activities, and the contractual model or the revenue model to be enhanced or improved. What of these assets will meet the required challenges, the required factors? Those are the monetization potential assessment subjected. And then you got the assets which could be considered for the monetization, and the valuation factor for each of the asset is multiplied, and you got what is broadly the high level estimate. High level estimate is, okay, if you ask me, okay, what's your GDP growth rate? We'll tell 7%, 6.5%. It's not 6.5%. It could be 6.3, 6.88, something. But the high level estimate is 6.5%. So interest rate or forex, you tell it's now 83.18. It's never 83.18. Forex exchange rate has always been 4 digits. Otherwise, it's not an estimate. It doesn't meet the contract requirement if you mention only 2 digits, isn't it? As per the forex contract. So that way they arrive at the high level estimate. Fine. So the assets, we have seen the assets, and these are the values what are identified for each of the sectors. Then roads constitute 27%. Percentage explains us better than the number, because we know the total value is 6 trillion, 6 lakh crores. And then the percent wise, railways and roadways are 52%. You can imagine now that the asset monetization program is not being discussed as an option. It is more a requirement for the economy, because these assets require efficiency improvement, further augmentation, etc. And of course, the other 13 sectors are also there. Now, we've come to our core, which is the valuation approaches. while we have the asset, income, market approaches, the asset approach is the cost approach, income approach is broadly the DCF approach, discounted cash flow approach, and the market approach is the multiples which we adopt as suitable for valuing the assets, be it land and buildings, the plant and machinery, or where they are separate, or and the financial, the securities. We apply all of these three. Those being the scientific methods across the world, and for us, the approaches identified, adopted, and stated by the government for NMP are as follows. Number one, market approach, which we know, but deserves a bit of discussion. What is that? The value of the asset should be based on comparable market transactions if available. So if there is a transaction in the market which has happened for similar asset at a similar value, adopting the similar value is the market approach. Then one of our professional colleague was asking me yesterday, what's the difference between approach and method? We generally tend to use them synonymously. Are they one and same? Of course, no. Market approach is multiples. Adopting the multiples, adopting the prices prevailing, that's approach. What's the method? EV by EBITDA is a method. Price earnings is a method. Market approach, market method are used synonymously, but it is market approach. The methods are those things. Income approach, capitalizing the income the asset earns into the days to come is income approach. Then what's the method? DCF is one method. Cap rate is another method. Then yield cap is another method. So there are multiple methods, although the popular one for income approach, not to be spoken wrongly by me and others as income method, the popular method is DCF. The popular method in income approach is DCF. DCF is a method, income is income approach of valuation. Now back to this discussion. The market approach, what government has explained for asset monetization valuation or for valuing the assets under monetization is per unit value of assets, such as kilometer of road, circuit kilometer of transmission line, power transmission line, the per ton, MT is ton, MW, megawatt for power plant. This is the per unit value of the asset has to be adopted. Then the adopted value will have to be averaged, considering the range of the quality and marketability of the assets being monetized. Two railway stations could look same, could have all the features equally, but will not be valued equally. Why? The station which will see more footfalls or more passengers could have more revenue generating potential than the station with all the same features, same setup, similar look like a twin in a place, in a location where less footfalls or less passengers are witnessed. Therefore, quality range, one part, marketability range, another part, both of them will have to be considered, and then the adopted value will be averaged. So in the market approach, this adjustment is not part. In the DCF approach, you may adjust. In a comparable method, you may adjust. So you are not adopting the industry price earnings multiple and declaring the value of any company as it. You are giving your adjustments. So those are allowed here also. So this is the custom-made approach. Then under this approach, the actual concession would depend on the quality of assets, the extent of the asset monetized. Is it fully monetized, partly monetized? Is it section-wise monetized, etc.? The tenure of the period, be it from 3 years to 66 years to 99 years, it depends, as you understand. If you have to monetize a land parcel, you offer it on lease for 3 years, you get peanuts as lease rent. You offer it on lease for 66 years, you get a tad lower than full consideration of the asset value. You offer it for 99 years lease, like in the case of Singapore and Hong Kong, where there cannot be free ownership almost, it has to be only on a lease period. Or, yeah, one of the other colonial places, you get amount as consideration which is as much as the complete pre-sale of the assets. One of those things like. Then the payment terms, upfront payment, deferred payment, revenue sharing partly out of that or levelized, and regardless of your revenue, you have to pay. It's like your EMI sort of thing. The example, it could be EMI, it could be upfront, it could be deferred revenue sharing, one of these things. So the payment terms also will decide the consideration to be paid, to be finalized between the parties. And the market price discovery should be through competitive bidding than on a nomination basis or a single approach basis or on a suo motu nomination basis, the Swiss challenge nomination basis. CapEx approach. So this approach we don't see, although it's nothing but the asset approach, cost approach. So our asset approach of valuation is cost approach. It is also CapEx approach, but not strictly, because CapEx approach is used only for infrastructure assets and is distinguished on several counts from asset approach. How is it distinguished? As we discuss this, we understand. CapEx approach is generally applicable for assets that are monetized through public-private partnership models. What's the value of this? The value is what is the CapEx that's required to create the asset? What is the CapEx that is required to augment the asset over a period of time, not upfront, not necessarily upfront? And why is this approach adopted by the government? If it is to be monetized at cost, what is government getting? Is what some of you must be thinking. If there is no premium and you are giving it exactly at the cost, what is the government is getting? Isn't the government losing the asset? No, because ownership is not transferred. It's only the right to operate and milch revenues that's transferred. And if there is no asset, what is transferred? The asset comes into birth only because you are giving the asset for development to the private party. So if the private party to which you are monetizing doesn't pick it up, there is no asset, and government has to invest the capex to create the asset, and the government is short with the capital. The capex could happen over a period of time, 2, 3, and sometimes even beyond also over a period of time, and that is the part of capex approach. So the capex plan for a seaport, the capex plan for a road is drawn now itself. And many of you, or I should say all of you, would be aware, because road is one asset class, commercial building is one asset class. There are a few others, of course, like port. These asset classes touch the minds and hearts of all three asset valuers. There is land and building in it. There is plant and machinery in it. And because these assets are of huge value, they will not be owned independently. They'll be owned or they'll be domiciled in a company, generally the special purpose vehicle. And once we say special purpose vehicle, the valuation of such SPV is only by valuing the securities of the SPV, the shares or the other instruments, which means when you're speaking about these kind of assets, any infra asset, and more particularly these assets, which involve high capex and capex spreading over a period of time, we are speaking about the valuation exercised by all our three brethren. Now, let's look at a port or let's look at a road. One example, road. You incur the capex to create the road. By the way, what road are we talking? We are talking about the road which is already existing or is getting expanded, widened from 2 lane to 4 lane, 4 lane to 6 lane, 6 lane to 8 lane, 8 lane to 10 lane. It's a brownfield project, existing, proven, revenues are consistent. You want to enhance the revenues, you want to enhance augment the features and privatize or monetize. The capex flows upfront for augmentation, and the capex keeps flowing once in 4.7 years or 5 years or 5.2 years, which is almost 1/5 of the original capex. In some cases where hilly terrains are there or in the northeast areas or extreme weather conditions are involved in Rajasthan, every 5th year you are investing almost 50% of the original cost of creation. How long would that go? Every 5th year over the future 25 years means 5 times there is a capex on this asset. Therefore, you adopt the capex approach than cost approach or simple other approaches for that kind of assets. That is what capex approach means. Depending upon the concession allowed, the revenues will flow to the private and the payout from the private is determined. The payout means the collection. The consideration is payout. Are you giving the concession for all? You are allowing them to maintain everything but collect revenues only for certain things. If you had a look at or if you had a thought of some of the public toilet facilities, quickly in your mind, the unacceptable condition where you would have found something good, a bit of appreciation on your face, unknowing smile, then trying to understand the financial part. They are collecting hardly 4 rupees, 5 rupees or 1 rupee. And how are they able to maintain such a big lawn here and such a good facility and the team here and the perfume and other things being maintained here? How is it possible? So we understand. And if it is only urination, no fee, etc., how is it possible? So you understand that it is the contract agreement, the concession agreement, which stipulates that certain services should always be free of cost, and the collection of user fee should always be only for these listed items. There could be cross subsidy, there could be viability gap funding, there could be lower consideration which is collected from the private by the government, because there is still welfare in this mechanism, in this approach. That is all possible because of this concession controlled operations. That is the regulatory restraint, regulatory power, what we spoke about when we spoke about the monetization, and to kill the apprehensions that assets are getting out of the control or ownership of the government. It's not. It is only the rights and the revenue collecting powers what are given as a concession to the private for a finite period, only. The payout models could be, which we spoke, revenue sharing, fee, premium, royalty, and with many variants. There can be many variants. Then the book value approach. So do we ever adopt book value approach? Of course, yes. And in our asset income market, where does that fall? In asset approach. In that, do we call book value approach? No, we call book value method. So what is method to us became an approach here. Dear learned professional friends, I think you would understand now. I'm sure many of you know it. For those who are unversed, what is method in our approach, asset approach, is approach here. That is the creation of this valuation approaches or models by the government, specifically designed for the asset monetization after studying the models which were adopted and which are prevailing in other economies. Now, into book value approach, it's suitable for assets such as plant and equipment, the industrial buildings, then vessels. Vessels are the ships and the crafts, the port crafts, and land certain land not having market comparables, maybe like railway land, the hinterland of the ports, or the port itself, etc. There is no hinterland for comparison which is at a port. So how do you adopt? You will have to go by book value only. There is no market for that land. There is no alternative market for the land. When would market approach bid well? Only when there are alternative usages for the asset will you see market approach fitting well. Else, what fits well? Cost approach, book value approach, asset approach. That is the same sense even here as well. Now, usually the value determination can be directly from the books. What if the government did not update its books and the value isn't a true reflection of its assets? You take insurance generally, and the IDV can be one of the base. Now, if you're talking about a port, there is no measure, seaport. To build a seaport, the capex could be something like 6,000 to 40,000 crores. 6 to 40,000 crores. To get a port insured sufficiently, the IDV would be in the range of 2 lakh crores to 20 lakh crores. Yes, you heard it right, 20 trillion. That is the risk a port of 6,000 or 5,000 crores has. Port construction with 5,000 crores, the risk sitting is 20 lakh crores. Small fire catching up can lit the whole of the straits and all of the crafts owned by you, not owned by you, the merchandise moving and the water getting burnt and the coral getting affected, the whole of the creek not being useful for decades. Now you can imagine why book value has come as an approach in the valuation studies of NMP, which is a simple methodology what we can adopt by looking at only one side of the balance sheet or one statement in our balance sheet, the assets and liabilities, and then you can come out. Or maybe simply you can look at the only asset side in your balance sheet, on the right side, the assets head, and you can state what is the book value. It's that simple for us, but not if you are understanding the book value approach in true sense. The cost to create asset is also understood, is first taken as the base, then you give the adjustment, which is broadly the depreciation, etc., and the asset features. And then how many more years can that be used? How many more number of hours can that be used? What is the period of the concession you are giving? As per those things, the valuation will be arrived at. Now, one important thing what all of us knew, but then deserves a mention is infrastructure assets have a long payback period, shorter break-even periods. Break-even periods will be short, 3 years, 2 years, 4 years. Payback period could be 30 years, 40 years. When will this happen? As you could refresh your mind, let me conclude. Only when you depreciate an asset over 30 years time, will your break-even period be shorter, earlier, and your payback period be longer. So that is required by the investors, which means you don't need an investor who would like to get the payback within 6 years, 10 years. That investor will never be able to give a value, will never be able to operate it, which means such an asset can never be created. That asset to be created requires someone to expect, be patient for a payback period of 10, 15, 20, 30, 40 years duration also. Break even could be earlier. The EV approach, it is not the same what we have. EV is only a model for us. EV is only a method for us, but it's an approach here. EV approach, which is prevalent widely in the infrastructure sector, where the assets are owned in the or domiciled in the SPV, is also a very interesting and important approach. But EV approach is usable only if the revenue stream is fixed. It could be for a road, for a rail, for a public toilet, what we spoke a while before, or a port, or a building where lease rentals could be fixed, etc. The user collection fees or the revenue streams, whatever they are, need to be fixed. Only then can you adopt EV approach. How is it arrived at? The net present value of all the expected revenue streams, considering the increased revenue streams over a period of time, as per the increased formula allowed. It could be like a road, the road tolling, the tariff is fixed and the escalation is fixed. Therefore, you can expect, if the tolls are the same, you can expect what is the tariff, exact revenue stream. So all these future cash flows are discounted, and then that is the base for the enterprise value of the asset. As we know, EV, the formula remains same here also. So enterprise value minus the outstanding debt plus the cash and liquid balances, if any, is the enterprise value. That value is monetized or is the valuation. Now, what we spoke until now are all valuation approaches. What does that give? Valuation. Is it the same as monetization? May or may not be. After you fix the valuation, from the valuation, the price discovery happens by virtue of a competitive process. In the competitive process, the bids could be higher than the valuation what you have bid, lower than the valuation what you have bid, and the actual consideration is fixed as per the price discovery mechanism. And the third and even more important thing is the payment structure and the payment methodology. So what's the structure? Escrow structure, direct payment, etc., loan payment, and then net to you or into the designated account, roll-in account, whatever. And the payment methodology, upfront, deferred, revenue share with an underwriting minimum amount, etc., etc. So there are three things. One, valuation, which we do for this asset monetization purpose, adopting these approaches because government stipulated these as the applicable approaches. Then, as we get the valuation, there is a monetization process, which is the price discovery. What we did also is price discovery. By the way, kindly don't misunderstand me. What we did is also price discovery. What we stated as valuation is the ideal value. The market has other factors, supply and demand, playing their roles much beyond our professional valuation exercise. So the stirred up demand and supply could vary the amounts what we stated as true or fair values. Then comes the payment structure. So the equation is valuation, price discovery, then payment structure. Now, these are the approaches which government said will be applicable as a high level estimate at the moment for these sectors. These are worth just quickly looking at. Roads market approach. What is market approach? Multiples. So per kilometer, what is it going at? 20 crores per kilometer, 4-lane road. 80 crores per kilometer, 6-lane road with tunnels. 120 crores per kilometer, complete tunnel, 6 lanes. These are the normative comparables which are found in the market as the metrics on which assets got traded, as per which capex got incurred or sunk, on which the revenues are earned and bank funding happened, a bankable document emerged, all of them happened. Therefore, market approach. Ports, capex approach. In fact, that was the example what I had to take to exemplify our discussion. Same goes here. Because what it takes to construct a new port, there is no port existing, or there are approvals, but construction has to happen, or there are only a couple of berths and the port is stifled with lower capacity utilizations, lower capacities, utilization being higher, capacity being lower. Therefore, you need more capacity to be created to cater to the demanded utilization. Then what do? You'll have to create more berths. Then can you create the berths? No, they cost you 3,000, 6,000, 10,000 crores. Then how do you create? By monetizing the rights to create the additional berth. Why would someone come in and create a berth? This is already an existing port. It has huge hinterland which is proven. It has connectivity of rail, road, air. It has the ecosystem which is already built, and it has the brand as a port. It has all the customs and the wharfage and the other approvals in place, and there is already some operation, high level operation happening. Therefore, your additional berth can just be an additional berth, enjoying all the other ecosystem and the other required amenities prevalent in the port. So the amount required to create the additional berth is the approach, which is capex approach. Airports, same example. Additional terminals, additional runways, or augmenting the airport, all capex approach. Railways has got three approaches. Railway stations, capex approach. Passenger trains, now privatized or monetized rather, capex approach. So railway station monetized doesn't mean railway station is sold. You can't sell police station, you can't sell railway station. They're only monetized for a finite period. Passenger trains, capex approach. Billing, collecting revenues, maintaining them, operating them, selling them. Couple of them are already on the rails, which we are experiencing. Freight terminals. Freight terminal, while it is different from a port, airport, we can understand it could be CFS, ICD, or any of those things, or it could be a general terminal, general freight terminal, but we can understand in the lines of a seaport or airport to understand the example. Then the railway colonies redevelopment. There are a lot of railway colonies where there is ecosystem, revenue flowing in, railway owns assets, they're on lease, and the revenues are helping the railways, etc. They need redevelopment, and therefore more commercial activities, retail activities could happen, and people are willing to pay because there could be a value addition for the asset. Capex approach. Track infra under dedicated freight corridor. Book value approach. Why book value approach? The book value is net of depreciation. And how are you depreciating? As per the usage in terms of numbers of years. If you have owned a ship, you will have to undertake dry docking once in 5 years. Are you enhancing the life of the ship? No. And you would tell me, Dr. Kishore, I'm spending 20% of the cost, something like 10 to 22% of the cost on dry dock every 5th year. Isn't it a capex? It is in English and accounting jargon. In valuation, isn't it a capex? No. If you don't dry dock it once in 5 years, the vessel loses its sailability. It will not have the IRS. It will not move, which means it is also in the nature of repairs and maintenance. Although it comes as a capex and a sizable amount and once in a 5-year period, and therefore it keeps the vessel afloat for revenues. Similarly, the overhead equipment on the railway tracks. The overhead equipments are now all electrical trains. They have huge overhead equipment, the swings and the cords connecting and running the train on electricity. That overhead equipment is very valuable. Those are by way of enterprise valuation approach, like any other tower, etc. also. Then power generation, book value approach. Power transmission, market approach. Power generation is the power plant at one place. Power transmission is the circuit transmission lines, what we spoke, circuit kilometers. The grid connecting. Power Grid Corporation of India Limited owns power transmission lines, the lines going around our houses and offices, etc., all of them. Natural gas pipeline, EV approach. Product pipeline is other than liquid. EV approach. Sports stadium, not there. Augmentation, capex approach. Warehousing, capex approach. Telecom has got both capex and market approach also. Tower assets by way of market approach, same like power transmission there. other assets, more particularly the BharatNet fiber assets which are created in the recent last 2 decades, capex approach, mining capex approach, and urban housing redevelopment also capex approach. Now, while we have not discussed very detailedly, that would have explained you broadly, and let us take 2 examples before we have our Q&A. For a road, the assets which are already monetized under NMP, National Monetization Pipeline, how it happened, what happened is this. For roads, they adopted market approach. What is market approach? Multiples. What are multiples? We spoke a while before. A hotel, hospitality asset will get sold or traded in the market with a high level estimate. We call it high level estimate, normative estimate, thumb rule estimate, or any other names. At what rate? 3 crores per key for a 1-star to 3-star hotel. 5 crores per key for a 4-star and 5-star hotel. So, on an average, normatively, if you are constructing a 100-key 3-star hotel, that should be 100 into 3. 300 crores should be the normative capex. But in reality, it is at 420, 430, 440. These are the evolving numbers, but the capex thumb rule is that. So what is the 3 crores or let us say 5 crores? It is the high level estimate, normative number, comparable. That comparable of 5 crores has evolved over a period of time, and 50 crore rupees per ton cement, standard. 25,000 rupees per bed hospital, standard. 3,000 rupees per student in a school as a goodwill, standard. These are all comparables. They are normatives, but normatives have come from the comparables. So in a market approach, we take the comparables. How are those comparables adopted? They have initial estimated concession value, which is the discounted value of all the future cash flows at a rate of MCLR plus 3%. MCLR plus 3% and 14% or 16% as equity return, working out the WACC. So let us say MCLR 8% or 9% for simplicity, plus 3, 12%, 12% for debt, assuming debt is 50%, just for the simplicity of computation. 16% for equity return. So the WACC is 6, which is 50% of debt in our simple example, and 8, 50% of KE, the equity return. 6 and 8, 14. 14 is the WACC or WACC, weighted average cost of capital. It is at this WACC you will discount all the future expected receivables, and then that is stated as initial estimated concession value. This is put to bidding, competitive process. Now, you are a competent organization, you have own funds, you don't need debt, you are okay for a lower return, you are a fantastic organization, you can mobilize debt at a benign cost of capital, you can bid higher amount, lower amount, whatever, depending upon your financial structure and operational structure. You are a company owning huge crushers, therefore your operating costs will be very, very low, and you're okay. You have some more return coming from there, and therefore you're okay for a lower discounting here or lower discounting here and give higher valuation to the asset. That's possible. So the supply and demand in the market will take the second step of price discovery after your valuation exercise is completed. Let us look at another similar example. So valuation of power transmission assets. Power transmission Power Grid Corporation of India Limited is almost near monopoly entity in India, owning all the power grid lines, and it incurs huge capex every year, huge capex. It needs a lot of capital, and it has been awarding contracts to the tune of 5,000 to 10,000 year on year. And there are a good number of companies which are dependent on only these power transmission lines, because power is critical infrastructure in Indian economic definition. For this, Power Ministry has issued guidelines. What did it say? The model has to be PPP, and the variant of BOT, the variant of build, operate, transfer, which is called as PPP base model, needs to be AOMT. What does that AOMT mean? Acquire, operate, maintain, and transfer. To acquire the asset, you operate the asset, you maintain the asset, and you transfer. What is this acquire? You will own. In this model, in this approach, what you study is, this is a BOT variant under PPP. So unlike assets not being transferred with ownership, but are only given on lease or concession or rights basis, unlike those, here the transmission line is transferred in terms of ownership also. You will become the owner of the transmission line. You acquire and you operate, you maintain, and then you transfer it back to the government or the authority, of course. And this AOMT model, like any other PPP model, requires SPV. As of now, the assets are already in SPVs. If they are not, there will be demerger exercise, and the transmission line, the section line which is identified for monetization, will be domiciled into an SPV, and the shares of the SPV will be sold to the private. And at the end of the life period, the concession period or the transaction life period, the shares will be sold back by the private to the government, to the authority, PGCIL or the relevant authority, at a nominal cost of ₹1. Some of the power sector generating assets also go on this model. At the end of the transaction life, they need to be sold back at nominal cost, token cost of ₹1 for consideration sake. It is from that period the SPV will again become company owned by the President of India. Until then, it would be your private owned company, because private sector owned company, because the assets are not only transferred in terms of operation rights, but also in terms of ownership rights. So I thought these are the two models which would explain us, and I chose to go to the point of what is the responsibility of the government. Of course, this could be an economic discussion, but then responsibility of the government. As of now, one of you may ask me, what is the status of monetization? Is it successful as per the stages? Answer is yes and no. Yes, because starting was good. Some of the assets got properly monetized. There were not many disputes. The valuation, the price discovery was broadly as expected. But the pace isn't as expected for various reasons. We have to just see why they are, which I also don't know. But the monetization of 22 to 25 may differ, because it would not be possible to complete the monetization of all of the assets. It may differ by 1 year, 2 years, but then the monetization program will continue, because the process has already commenced and the competitive procedure also has kicked in. Now, to continue this NMP, to adopt these valuation methodologies, to involve professions like you and me for the valuation exercises, to remain answerable to the citizens, the subjects of the government, what are the minimum responsibility factors for the government? These are: auctions should be transparent. Auction in the sense, the competitive bidding. Valuation should be transparent. Here, this valuation is the monetization value. What you and I would give is the valuation as per the approach which they stipulated. But then that is subject to the adjustments what government would do, and is subject to the price discovery also. Transfer rights than ownership. So In the case of this power transmission, you would question me, isn't the right of asset transfer? It's more like, it is almost like a repo. Private cannot own the power transmission forever. It has to transfer back the asset. Therefore, while the asset ownership is also transferred, it is not an absolute transfer. It is only a conditional transfer. Such should be the spirit across. There are companies which are smart enough, as a couple of our professionals were implicitly mentioning, that they will mobilize maximum debt and then they leverage, and then with wafer thin equity or maybe almost negligible equity or zero equity, they could acquire companies by mobilizing bank funding. Then what are you doing? You are giving ownership, and the funds again come from public sector banks. So government is giving from one hand and taking from another hand without gaining anything at all, but the revenues would go into the hands of the private. That should be avoided. And how do we avoid it? By stipulating that LTV should not be more than some percent, and by regulating the banks not to over lend to projects of these things, to ensure sufficient skin in the game for the private parties who are acquiring assets in the NMP program. You got asset monetization done, the proceeds are on hand. Do not use them for welfare measures, distributions, publicity, or branding, etc. Do use them for further infra projects, which is part of the NIP, National Infrastructure Pipeline. Render your regulatory monitoring in a conducive manner. So we have been seeing some of the ports and some of the leased assets not being regulated properly, even some of the roads as well, not being regulated properly. And who are the losers? Private, or the users, not private, sorry, the users. That should be avoided. Be judicious in balancing private and public interests. Should there be a concession required, like in the case of Corona time, you allowed the waivers of concession payments, balanced, fine, and you allowed, at the same time you allowed private to ply on the roads without paying concession. So it should not be you charge the money from the private, but you don't need to pay the concession period user charges or the revenue share because there is Corona. It should not be that way. Initially it was that way, but got corrected. Now you can understand. Private were the road owning SPVs were allowed to toll, whereas the SPVs are given waiver to pay the amounts to the government. How is it justified? So that kind of imbalancing should not be there unless there is justification. Set a model for participation by quality private players. So unless the NMP has transparency and professional approach and proper model set and proper administration done, you will get players who are exploiters. You will not get professional players. You must have been hearing to a lot of chairman and MD level people, we don't deal with government, we'll be one version. We deal only with government, another version. Now you can understand who would say we deal only with government. It's not because they found government as a better partner, it is because they can exploit. And the other part, why do they so? It's not because they are averse to government. They are averse to the bureaucratic or the rigmarole what is involved and the lack of transparency, the opaqueness, what is widely prevalent in those transactions. That stigma needs to be removed, eliminated very carefully and completely. Then, finally, you should disclose the progress of the project's monetization, the receipts, and then keep everyone informed that there is no mismanagement or misutilization of the funds in the whole process, which can happen only if you have transparency and the quality players can come, the interest can be balanced, and regulatory monitoring will be there. All of them will be possible if you have consistent approach in your policies and implementation. Here we go. So we can take a couple of questions. Should there be any? Sir, I am done and we can take a couple of questions, sir. Should there be any?
Somebody has asked what is LTV? Can you please elaborate the term?
LTV, loan to value, sir. Some other person has, one of our other colleague has given answer. So loan to value means.
I only.
Okay. Thank you, sir. Loan to value, when you mobilize, it is basically the debt portion on asset value. When an asset is put for sale, you would mobilize debt to the extent of 70%, 75%, 80% like that. So for a housing loan, 85% is LTV, which means your 10 lakhs house can allow you borrow 8,50,000 rupees. That is LTV. So your vehicle will allow you 75%. So each of the asset has got normative LTVs. So we were quite aggressive in ICICI in allowing higher LTVs for some sectors where we had appetite to build loan book. We were very conservative on LTV in the sectors where we chose to reduce our exposure or to securitize our asset loan books. So this depends. LTV is percent of loan on asset value in simple terms. And once the full form is given, it is known to all of our members. There is no.
Thank you, Dr. Kishore Nuthulapathi, for an excellent presentation. And it is unique and mostly, usually, we cover the topics on only on valuation. But you have taken a new topic and covered how they are valued. Say in this monetization of the assets. Monetization of assets is an important task before the government to mobilize more funds for the further development of the economy. So in this context, this topic assumes greater importance, and I understand from the newspaper reports that this year also, or next year also, I'm not sure, that the central government is missing the monetization targets because of probably due to the polls on ensuing polls. So you have covered the subject very well. Then you have covered various valuation methods for which are used for monetization of these methods. And I hope that this topic will be useful for all the valuers, particularly the land and buildings, then in SFA in particular, and the P&M wherever assets are involved, physical assets are involved. Starting with what is savings, what is the need, the why it is required, and it has, as some of our members have raised a question whether higher savings are detrimental or beneficial for any economy. I too wonder whether the high rate of savings are useful or not. Because if there are high savings, then the consumption will be reduced, and thereby the development will be coming to halt or at a slower pace. So it is a wonderful question for discussion. And you have also covered the backdrop of the infra investments, and then the total government borrowings, increase in borrowings, so what are its necessities, then implications, etc. Sources to fund the core fund infra and NNP, monetization of assets owned by the central government, then the challenges before the government, the reference to asset monetization, like say what are the companies around the world which are monetized, like British Telecom, Chicago Parking Centers, parking meters, investment in China Mobile, etc. Disinvestment of China Mobile, etc. Benefits to the government, and the valuation methods, benefits to the investors. So why, how, and how the investors will be benefited by the way of monetization of the assets owned by the government. Then broad scheme of monetization, good features of asset monetization, objectives of national monetization pipeline, then the assets and variables, framework featuring NNP, approach of NNP, the valuation approaches through which the assets are valued, and responsibility of the government, etc. You have covered wonderfully. I hope that this topic will be useful to the members of this
And
community.
from my side, thanks to you, sir. Thanks to you, and I appreciate the participation and the presence of other members as well.
As a token of our appreciation and gratitude to you for your wonderful presentation, we are presenting one memento to you. It is.
So from my side, I have to place appreciation for the participation of all the members, and in particular yourself, Vijayalakshmi ma'am, and Sri Ram Taduri garu, and Professor Venugopal garu, and all the other members as well. And thanks for the nice appreciation.
This
We
memento
hope
will be
to-
couriered to you by our admin Vijayalakshmi.
Okay, sir. Thank you, and special thanks to her. So early morning, 6 o'clock, she gave a reminder
Yeah.
not to miss on the timeline. I
Yes.
appreciate her.
Our BBA seminars and webinars are held regularly on second and fourth Fridays is 7:30. If it is second Saturday, fourth Saturday, 7:30 means our president of a BBA, Mrs. Shilpa Kiran will be waiting for inauguration of the session. So that much punctual we are, that much committed our members, and luckily we get very good faculty like you. And in future also we look forward for hearing from you, very good evaluation topic like this. Thank you.
Sure,
And thank you all participants for your interest and dedication to attend this program and be benefited. Good day to you all. Happy week.
Thanks, sir. Thanks. And good day to you all.
Namaste.
Namaste. Thank you.